Hello everyone and welcome to today's webinar all about your retirement options and exploring your retirement options in a post-COVID world, how you can still maximise your retirement income. Now when we were putting this webinar together, it was sort of the back end of last year, and we thought at the time we'd hopefully be seeing the end of COVID soon, but obviously in the past few days we've had more restrictions announced. So hoping at some point soon we will see the end of COVID, but it should definitely not put you off your retirement planning. Even though COVID's around, you should still be very much thinking of your retirement if that's the position you're in. So before we kind of get onto the main webinar, bit of housekeeping. This webinar will run through some financial information, but it's important that you understand that this webinar is just for guidance only. It's not advice. Everyone's situation is unique to them. So if you do want to explore some of the subjects we covered today in more detail, I urge you to seek out help from a qualified professional financial advisor. And it's really important you stay till the end because everyone on the webinar today is entitled to our new free 10-minute retirement plan guide, which is available to download. So I'll explain at the end how to get a copy of this document. Also, we'll be sending out a recording of the webinar. But if you do have any questions during the webinar, just pop them in the Q&A box on the screen and we'll try and get to them at the end and answer as many as we can. So before we go into the main part of the webinar, just explain who I am, the guy that's talking to you today. My name's Carl Roberts. I'm a qualified, registered and practicing financial advisor. My path originally started down the legal route. I did a law degree at university. But once I finished my law degree, I just sort of got a bit fed up with law and felt it wasn't really for me. I'd always been fascinated by money. I'd always been a good saver and interested in economics. So rather than pursue my legal practice course at the time, I decided to set about my financial qualifications and then became a chartered financial planner. And now I'm a fellow of the Personal Finance Society, which makes me one of the most qualified financial advisors in the country. So I've always loved learning and I continue to study and take courses up to this day. Now here is a picture of my grandmother's wall showing all the graduation photos of her grandchildren. And my younger brother Sam is similar to me, and whilst he is not involved in finance, he is constantly learning, and we have a healthy rivalry over who can do the most degree level courses with the ultimate aim of having the most graduation pictures on my grandmother's wall. Now my first job in the world of finance was working for one of the largest mortgage providers in the country. And it was around 2007 during the great financial crisis. And I'm sure many of you on this webinar today will remember this period. We saw the financial system nearly collapse. Banks were nationalised, the biggest unemployment numbers in recent times, and a big hit to GDP. But the worst part of this period was, for me, was seeing actual real life examples of colleagues losing their jobs in the banking industry, people losing their homes through repossessions. So it sparks a bit of a passion in me to start helping people manage their wealth better, to avoid these issues and make the most out of their life. So if we fast forward today, I've created and I now run RTS Financial Planning, which offers financial advice and investment management for those particularly thinking about retirement. So enough about me. Let's get on to today's main webinar. So why is thinking about your retirement options so important? Why not just work until you feel like it and then retire? Well, there's two key reasons why you should really think and plan your retirement in advance. And the first of those reasons is life expectancy. We are all living longer and your savings and investments are going to have to last you a long time, probably a lot longer than you originally thought. So here's some interesting statistics from the Office of National Statistics, which shows the average life expectancy for a female on the left-hand side and a male on the right-hand side. So on the left-hand side, this female is, if you're 55 today and you're female, your average life expectancy is about 87 years. What I find really interesting is the 1 in 10 chance of living till 98 and 97 for a man. So if you retired at the common age of 65, that's nearly a 35-year retirement, 35 years to make your money last. And a sort of 10% chance of living to age 100 might not sound like good odds, but you've got to understand that these are average expectancy. So there's going to be, 50% of people living longer than the average and 50% people living less. And it's a sad fact that people who live in more wealthy areas, who have more wealth, will live longer than those that don't. Now, this is a picture of Angela Hooter. And at the time of putting this presentation together, she was the UK's oldest survivor of COVID at age 107. Age 107. She survived COVID. She says her secret has been eating an orange every day. But when you look more closely at her story, she has survived 2 world wars and 5 respiratory pandemics, so she clearly has some good lungs on her. Now, does anyone recognise this? So this is a birthday card, also known as a telegram, from the Queen when you reach age 100. And around 10 years ago, they actually had one person in the royal household working full-time on sending these telegrams out to people turning age 100. Now, 10 years on, today, there's now 7 people working full-time in the royal household sending these out. And this is due to a 75% increase in the amount of people turning age 100. When putting financial plans together for clients, I'll quite often show a timeline all the way to age 100. And a lot of clients will turn around and say to me, Carl, there's no need to do that. We can't see ourselves living past the early 80s. Our parents died before then and we'll follow their path. What's interesting is that the genes passed down from your parents are only actually related to 1/3 of the cause of your mental decline. 2/3 is actually lifestyle. So the fitter and more healthy you are, the more likely you will outlive your parents. And think about what we know about health and lifestyle now compared to 30 years ago, and what we're going to learn over the next 30 years. So for more information on the subject of longevity and why most people are going to start living to age 100, I highly recommend this book, The 100-Year Life by Linda Grattan and Andrew J. Scott. It's going to be fascinating to see what changes will be required to lifestyle and work in order to cope with a 100-year life. There's also a website that accompanies the book that allows you to take a short test, the results of which will tell you how prepared you are for a longer life than you were perhaps expecting. So longevity is definitely a key reason why you should be thinking about your retirement and planning ahead. The other reason is because, frankly, there's so much choice in how you plan your retirement nowadays. There's so much choice in how you create your retirement income. There's so many different pension options, and we're going to explore that today. So if you're planning to retire, when you eventually retire, you're obviously going to finish working, you'll give up your salary, and you're going to need some form of income to live on for the rest of your life. And this income can come from many areas. Now, it may come from savings. If you've got savings in a bank account and you're earning interest on it, admittedly, you're probably not earning a lot of interest at the moment, but this interest could obviously provide you with an income in retirement. You may own investment properties, buy-to-let properties, and receive rental income from those properties. That could give you an income in retirement. You also may have investments. You may invest into shares, and these shares may pay you a dividend every year, which again gives you some income. Or whilst you may retire, you might still own a business, and you might not be working that business every day, but you might still be receiving an income from that business. But for the purpose of this presentation, we are going to focus on pensions, as this is a product that's specifically designed for retirement. Now, when it comes to pensions, age 55 is the magic number. It's the magic number because this is the age at which you can access your pensions and withdraw money or take an income from them. Now, the age is changing to age 57 in 2028. Now, that has not become law yet, but the government have constantly said they are planning to make this change. They just haven't got around to changing it in law. So do keep an eye on that if you're affected by that age increase. So you can access your pension at 55, that's the minimum pension age. But obviously you don't have to access it at 55. Most people are still working at 55. So there's no point taking money out, which is going to add on top of your salary and therefore be taxed. But the key thing is the choice is yours. Your pensions have changed a lot in recent years and can now provide so much flexibility. But unless you explore all your options fully, you might pick a bad deal that's irreversible and not something you want when you're in your 90s. So before looking into pensions in more detail, what should you be considering first? How do you start making a plan? What should you be thinking about? Well, of course, the main thing you want to understand is, when do you actually want to retire? Now, I'm sure if I asked a lot of you today, you'd say you would like to retire right now. But when would you realistically like to retire? It's good to have a target. You really need to understand what pensions you have. As we're going to go through today, all different pensions work very differently. So you need to understand what yours are able to do for you. How do you feel about risk and certainty? Would you prefer a guaranteed income in retirement? Or would you prefer your income to change if your lifestyle is going to change in retirement? And importantly, what do you want to happen to the money you leave behind after you've gone? So there are essentially 3 different types of pension you may have come across during your life. And we're going to look at each type today and show you how your retirement choices are very different. So first off, we're going to start with the state pension. So as long as you have paid national insurance contributions at some point in your life, it is highly likely that you have built up some entitlement to a state pension paid by the government. Now, the government controls what you will be paid and at what age you receive it. The current weekly rate is around £175 per week, coming to around £9,000 per year. And whilst you wouldn't want to rely on this to fund your retirement, it does amaze me how many people I speak to have forgotten about it or don't even realise that they are due a state pension. If you're a couple, then 2 full state pensions coming to around £18,000 a year in retirement is not to be sniffed at, especially as you will be paid it for as long as you live. Now, once in payment, the pension income you receive will increase each year by the higher of inflation, average earnings, or 2.5%. And this is known as the triple lock. You have very little flexibility or choice with the state pension. You can't take it earlier, you can't take lump sums from the state pension. The only thing you can really do is defer taking your state pension to a later age. And you might do this perhaps if you're still working and you don't want the increased tax bill by receiving more income. But let's just take a step back in time for a minute. The original state pension, otherwise known as the old age pension, was first paid out in 1909. And it was payable from age 70. And at the time, only 1 in 4 people made it to 70. And if you did get to age 70, you weren't expected to live very long. Life expectancy was around 9 years. So not many people lived to see their old age pension. If they did, they didn't receive it for very long. And this suited the government. But today's governments have a very different problem. You see, state pensions are not funded out of one huge government savings pot. Your national insurance contributions don't go into your own pot ready to pay out to you when you reach state pension age. Your national insurance payments paid today go towards paying today's state pensions for people that are retired. And the problem is, as we found when we looked at longevity earlier, the numbers of retired people are growing as they live longer. So much so that back in 2015, we had 4 workers for every person age 65 plus. But by 2050, it's predicted we'll only have 2 workers for every person age 65 plus. This means less national insurance contributions coming in to pay all those increased state pensions. So what have the government been doing about this? Well, remember, back in 1909, if you reached state pension age, you only received payments for a few years before you died. But now, if you're going to be living to age 100, that means 30 plus years of payments. So governments have been pushing back the age at which you receive the state pension. And this has been particularly damaging for women who have seen their state pension age rise from 60 to 67 in just a few years. And it's predicted that the state pension age will rise further and faster in the years ahead. Now, the government have a really useful website that is free to register for, And once you log in, you'll find your own state pension record. And this will tell you exactly when you're going to receive your state pension and what you're forecast to get. It'll also tell you whether you've got any gaps in your national insurance contribution record. So it's a really good website. I really urge you all to register for that. It's free. So we've covered the first type of pension, the state pension, and found that there's not really much flexibility with it. Next, we're going to look at the defined benefit pension, also known as a final salary pension. Now, if you work in the public sector, so if you're a teacher, police officer, work in the NHS, your pension will be a final salary defined benefit pension. And these pensions were once considered the gold-plated pension benefit and usually offered by the large, long-standing UK employers. Nowadays, most private sector employers have closed these types of schemes to further benefits. So this means that they're now deferred until you take the pension. Because much like the problem with state pensions, employers have realised that people are living much longer than expected, and the cost to keep paying out these pensions is too big. Now, if you're lucky enough to be part of a final salary pension scheme, then what you get paid at your retirement age will depend on your earnings while working for the employer who the scheme is with, the number of years you have worked or have worked for the employer, and something called an accrual rate. The reason these pensions were seen as gold-plated is because of the level of income you can potentially receive and the guaranteed nature of it. And once a final salary pension is in payment, it will likely be protected from inflation and rise each year and is guaranteed until you die. So just looking at a quick example, if you'd worked for a company for 30 years, your salary at retirement was 50,000 and the accrual rate was 80, the calculation to work out your pension income would be 50,000 times 30 over 80, which gives you £18,750 per year guaranteed pension income. So whilst final salary pensions can appear great, they might not fit the type of flexible retirement you want. So let's just look at a few pros and cons of the defined benefit pension. So the advantages are that you get a guaranteed income for life. So this is perfect for people who are very uncertain. They like the certainty of income and don't like risk. This type of income is usually protected from inflation, so it will rise. The income will rise each year and go in line with rising prices. And you tend to find that most of these types of schemes will pay some form of income to a surviving spouse on your death. And of course, there's no need to worry about the stock market because you're not investing this money. It's a guaranteed income that's paid out to you from the employer you worked for. But in terms of the disadvantage, these types of pensions are very inflexible. You can't change your mind. Once you've retired, taken your defined benefit pension, that's it. You can't stop it. You can't increase it. You can't change your mind. And whilst we say there is a form of income paid out to the surviving spouse, there's no other lump sum benefits. And if you're not married or your spouse dies before you, then there's no benefits at all. Your children will not receive anything. And whilst we've said they're guaranteed income for life, they're only guaranteed as long as your employer remains solvent to continue to pay and fund the pension. Most schemes are in deficit at the moment. So if you have a deferred private sector final salary pension, but it doesn't look like it's right for you, what can you do? Well, a few years ago, I had a client called David who was about to turn 55. He had worked for BT all his working life, and he was due a final salary defined benefit pension of around £30,000 per year at age 65. At age 65. The problem was David didn't want to retire at 65. He wanted to retire now at 55. He knew he could access his pension at 55. He knew the minimum pension age was 55. So we wrote to BT and asked them what they would offer David as a pension income if he was to retire at 55 instead of 65, which was written into the scheme rules and was the normal retirement age. And BT came back to us and said that they would offer David £15,000 per year if he was to retire at 55, a guaranteed income of £15,000 per year. Now, so this was a 50% reduction in what David was originally offered, £30,000 at 65, for taking his pension 10 years earlier. And obviously, BT had to do something like this because normally they were expecting David to retire at 65. He was going to retire 10 years early. So that meant BT would have to pay the pension for 10 years longer than they were previously expected. So obviously they applied a penalty for that. Yeah, but the penalty was quite severe, a £15,000 drop in income. But the other option David had was to apply for what's called a cash equivalent transfer value, which basically means David offers to give up his guaranteed income for life for a cash lump sum, which can be transferred to a personal pension. So he wrote to BT and asked for this figure. And BT came back and offered £800,000 in order for David to give up his guaranteed income for life. David's position, he wasn't bothered about the guaranteed income for life. His wife Jane also had a final salary pension, plus they had their 2 state pensions. This covered all their basic needs. And David really wanted more flexibility in how he took his income. He wanted to retire early, and crucially, he wanted his family to be able to benefit from his hard-earned savings should something happen to him. So that's what he did. He took the cash equivalent transfer value, and he's now happily retired. Now, I'm not saying you should all do this if you've got a deferred private sector defined benefit pension, but you should probably at least review your position and understand what the right option is for you. And we're going to cover more on this subject in a future webinar, probably coming up in March, all about defined benefit pensions and whether they should be transferred or not. So do look out for that. So our third and final type of pension is where it gets really interesting. A defined contribution pension is now the most common type of pension set up by most employers, or it's a pension you could set up yourself. Now, it can have many names, occupational pension, stakeholder pension, personal pension, but they pretty much all work the same. They're all defined contribution pensions. And the way these pensions work is that you have your own pension pot, a bit like a pension bank account. You pay in, your employer pays in, and you get tax relief from the government to incentivize you to save for retirement. And this tax relief from the government is what makes paying into pensions really effective. If you're a basic rate taxpayer, you're going to get 20% income tax back topped up onto your pension contribution. And if you're a higher rate taxpayer, you're going to get 40% tax relief. What other investments gives you an immediate 40% return on the contribution you make? I'll tell you now, there isn't one. So pensions are a really good saving vehicle for retirement. But unlike the state pension or final salary pension, there's no guaranteed income for life. You've got your pension pot, you don't know in advance what your retirement income will be from this pot. Your pot's invested, and the ultimate value of your pot at retirement will depend on what you have saved and how well your investments have performed. And it's really important that you keep an eye and monitor your investment performance and choose the right investment for you. Keep those annual statements, look at performance each year, and compare values. So what happens at retirement with a defined contribution pension? Well, there are essentially 2 different ways you can get your money out of a pension. And the first option is what's called an annuity. And this is basically where you can turn your defined contribution pension into a final salary type pension, sort of doing the reverse that David did earlier. It means you sell your pot to an insurance company, and in return, they offer to pay you a guaranteed income for the rest of your life. Now, before doing this, you can usually take out a lump sum of up to 25% tax-free before you purchase your annuity. So here's a little example how annuities work. So this lady has built up a pension value at retirement of £266,666. She wants to take out the tax-free lump sum, so 25% comes to £66,666. So that means she's got £200,000 to purchase an annuity with. At the time of doing these quotes, she was able to get a level fixed annuity of £9,510 per year. But the key word here is level. A level annuity, so this means the payment stays the same every year for the rest of our life. Now, this might not be very good in 20 years' time when everything is more expensive due to inflation. So you can add on additional features to an annuity, like an increase in income in retirement, a payment that continues after your death, protection for the first 5 years if you were to die early. And in terms of tax, once in payment, the annuity income adds on to all your other income and you pay tax at your marginal rate. And the problem with annuities is again, there is just so much choice in the type of annuity you can get. When you set up a defined contribution pension, you have to state at which age you think you will retire. And most people put age 65. And what happens is as you approach this age, your pension provider will write to you and offer you their annuity rates at the time. But there is a whole open market out there of annuity providers. So if you think an annuity is right for you, you must seek alternative quotes and look and try and get the best quote you can. Don't just go with the first option you're offered. So if you like the sound of an annuity and the certainty it can bring, then you first need to consider a couple of things. Do you want your income to die with you, or do you want a reduced payment to your spouse? Do you want the same level of income every year, or do you want the income to keep rising each year to keep up with the rising cost of living? Do you want some form of protection that should you die early, after taking your annuity, your family can still benefit from a lump sum payout? Do you want or need a tax-free lump sum before you purchase your annuity? And are you in ill health? So being in ill health is really interesting when it comes to annuities, is they're the one product that kind of rewards you for being more ill. So if you're someone with a smoker, high blood pressure, a history of illnesses, then you need to put that all into the annuity application form because you will get a higher rate. And the reason for that is because obviously the insurance company's not expecting you to live as long as others. So it can pay you a higher rate for a shorter period. So just to summarize the annuity situation, the advantages of an annuity are that you get a guaranteed income for the rest of your life. It's administratively simple. Once you've set up the annuity, that's it. You'll get your income for the rest of your life. You don't necessarily have to worry about running out of money if the annuity income you've got covers all of your spending now and in the future. And you can increase the income if you're in poor health. So annuities can be beneficial to those in poor health. But the disadvantages of the annuity is that the annuity income offered will always be based on current interest rates. And currently interest rates are very low. So that means the annuity income offered will be low. It isn't a reversible decision. So if you decide to take an annuity and you sign and it all starts up, you can't change your mind in the future. That income will continue to pay for the rest of your life, and then you can't stop it, you can't increase it, that's it. There's no flexibility once you've made that decision. And frankly, the death benefits are limited. Whilst you can have a reduced income to the surviving spouse, once the surviving spouse is gone, or if you're not married, then nothing will be left for your children. You can't have a children's annuity. So death benefits are limited. And you will be penalised for retiring earlier. So if you're someone like David who wanted to retire at age 55, your insurance company will do the same thing that BT did. They will reduce the income they offer to you. So the alternative to an annuity when it comes to taking money out of your pension is to go for something called Drawdown. And back in 2015, the then Chancellor George Osborne announced what's called pension freedoms. And before this, you were basically forced down the annuity route with your pension. You didn't really have any other option. You had to purchase annuity at some point. But when it came into force in 2015, pension freedoms basically gave people full control over their pensions so that they could do with whatever they wanted with them, including taking the whole lot out in one go from the minimum pension age. So your pension now can be thought of as a big savings account. Think of it a bit like a bucket with a tap on it. You can turn that tap on and off as and when you need to. You can take out lump sums, a regular income, or withdraw the whole thing. Now, there's no guarantees with Drawdown, the pension will remain invested, and the more you take out and the worse your investments perform, there's a good chance your pension runs out before you. And remember, it may need to last over 30 years in your retirement. So let's just touch on the tax situation with drawdown. So, if you're still working, you're over 55, but you're still working and you fancy taking some money out of your pension pot, let's say you're earning £50,000 salary and your pension pot's 250,000, and you quite fancy a withdrawal of around £66,666. Well, 25% of that amount could be taken tax-free, and the remaining 75% of that withdrawal will be added to your salary and taxed at your marginal rate, which in this scenario would be 40%, meaning a £20,000 tax charge for withdrawing 66,666. So it's really important you always consider your tax position and know what you're doing. Whilst these flexibilities and freedoms are great, you can be hit with hefty tax bills if you don't fully understand the tax situation. So drawdown can be ideal for those people looking for a more flexible retirement. I've worked with many clients over the years and taken them through retirement, and quite commonly the retirement will go into these sort of three phases. So once you retire, you're in the exciting period of your life. You've just retired. There's lots you want to do. There's lots of trips you have planned, things you want to do around the house. So you do tend to spend a bit more when you first retire. And then, after that initial period, things tend to slow down a bit. You've done most of your traveling. Things become a bit more routine. And then your sort of final phase of life, you'll find everything really slows down. You're not really traveling as much. You might go down to one car or no car at all. And you might start helping out the children. So spending again can decline even further. But then sometimes it does shoot right up towards the end. If your health really deteriorates and you need help with care, then that can be quite expensive. But the point is, you need to really think about what your retirement spending will look like. How much flexibility do you need to be able to change your retirement income to fit with the different phases of retirement? So summarising and looking at drawdown, in terms of the advantages, it really does offer you that full flexibility and control over your pension pot. You've got the full lump sum death benefits. So if you're someone that's keen to leave money behind to your family, especially your children and grandchildren, this is the option for you. This will allow you to do it, because whatever left in your pension pot at the point you die can be left to anyone you like, tax-free, pretty much. Your pension can continue to grow. So even if you start taking an income from your drawdown pot, because it's still invested, if your investments do really well, you may find that your pension still continues to grow. And because it's fully flexible, you still have the option of purchasing an annuity at a later date. For example, if we go back to those phases of retirement, if you find you're in a phase where everything just becomes routine and you're clear on what your spending is going to be for the rest of your life, you could potentially purchase an annuity at that date. And drawdown can be really useful for tax planning as long as you know what you're doing. If you want to decide to go back to work after retiring, you could switch off the income so you're not hit with additional taxes. But of course, there are disadvantages. And the big disadvantage is the fact that your pension could run out. There's no guaranteed for the rest of your life, especially if you're not in control of the investment risk and the investment returns. So it does require more ongoing management being in drawdown. And potentially you could pay higher rates of income tax if you don't know what you're doing and you take out too much and go into a different tax band. Now, you can have the best of both worlds with annuities and drawdown. So you could take part of your pension and buy an annuity and leave the rest into drawdown for more flexibility. And there are also some providers out there that offer flexible annuities where you receive a fixed level of income for a certain period. And at the end, if investments have done well, you will increase the income for the next 10 years. So we've looked at annuities and drawdown, but the other option is, of course, you can do nothing. You can leave your pension invested for as long as you like. And this can be a great way of passing wealth down the generations. So let's look at what happens to your pension on death. So for the state pension, there is no death benefit. Even though you could have worked all your life and then died shortly after receiving your state pension, there is nothing your family can inherit. The only thing a surviving spouse can do is use some of their deceased partner's state pension to increase their own to the maximum if they don't already have the maximum state pension. And as we've seen with defined benefit pensions, the position is similar, although there is usually the ability for the surviving spouse to be paid half of what was previously paid. There's no lump sum death benefits though, really. But for defined contribution pensions, the picture is much better. So again, when George Osborne announced pension freedoms, he also made pension death benefits much more generous. And the situation is like this. If you die before age 75, then whatever is left in your pension pot at that point you die can be left to whoever you like, completely tax-free. So there'll be no inheritance tax to pay, and your beneficiary will be able to withdraw amounts out of the pension without paying any tax. So they can take out the whole lot if they wanted to, tax-free. It changes slightly after age 75. So if you die after age 75, then there's still no inheritance tax in passing the pension pot to your beneficiaries, but the beneficiary will pay income tax at their marginal rate when they decide to make withdrawals on the pension. But this could still be a really good way of leaving pensions to younger children, and they might not touch the pension until they've retired. So ignoring that income tax for a long period of time and giving them a really good start in terms of their retirement. But it's really important to understand that pensions are not dealt with via your will. Now, your will has no control over what happens to your pensions. In order to decide what happens to your pensions on your death, you need to instruct your pension company who you would like to benefit. And this is done by something called an expression of wish form, or it's also known as a nomination of beneficiaries form with some providers. It's really easy to do. You just request the form from your pension provider. They'll send it to you. There'll be a couple of questions on it. You just complete it and lodge it with the pension company. And you need to check this on a regular basis, because you'll be surprised how many times I review people's pensions and find that the ex-wife or husband is still nominated as a beneficiary. Now, you can change your nomination as many times as you want throughout the year. It's always free to do. So coming towards the end, sort of wrapping up this webinar and the options we've looked through. So to summarize, when it comes to retirement, there really are three types of pensions you need to be aware of. We've got the state pension and a defined benefit pension, which only really offer you a guaranteed income, although you could technically convert the defined benefit pension. But the defined contribution pension offers you far more flexibility. So you've got the best of both worlds there, where you can potentially opt for the guaranteed income of life, or you can go down a flexible route with drawdown. So you really need to think about the type of retirement you want to live and ensure that your pension is appropriate for it. So I mentioned at the start that everyone on today's webinar is entitled to the 10-minute retirement plan guide that we've produced. So following the webinar, you will receive an email from me, which will have a recording of the webinar and also the link to download the guide. Okay, so we've just got time for a few questions. So I'm just going to have a quick look to see what's come through. So if you have got a question, do put it in the Q&A box now, and I'll try and get through to it. If there's some I can't get through to, I'll come back to you separately. So just have a look here at what's come through. Okay, a couple of people have asked about the recording and slides and things. So like I said, following the webinar, I'll send you out an email which will have a link to the webinar recording, and you'll get that free guide. Someone here has asked, can you use your pension to buy property? That's a really interesting question. Technically, yes, your pension can purchase property, although it can only purchase commercial property. So buildings like warehouses, shops, that kind of thing. It can't purchase residential homes. So your pension can't purchase a buy-to-let residential property. In order to purchase commercial property, you will need a certain type of pension called a SIP. But if you do have a SIP, then technically, yes, you could purchase commercial property. Question here, if my defined benefit pension is in deficit, does this mean my income will be reduced? No, is the first answer. So your income that's due to you from a defined benefit pension is written into the scheme rules and can't really be changed. So providing the employer remains solvent and you retire at the normal retirement age, you should in theory know what income you're going to get, and that shouldn't be reduced, regardless of if the company is in deficit. The problem comes if the company doesn't remain solvent. If the company employer goes bust, then the pension could potentially fall into what's called the pension protection fund. And if it does go into there, then its likely benefits will then be reduced. Okay. Someone asked here about expression of wish forms and how they're used in income drawdown. Exactly the same way. So whether you're contributing to a pension or you've retired and you go into drawdown, it's the same expression of wish form, works both ways. So if you filled one in, whilst you've been contributing, you don't need to change it necessarily by going to drawdown, unless you've changed your mind on who you want to benefit from it. Okay, someone's asked here, can I take my tax-free cash lump sum and put it in an ISA? Yes, you can technically do that. You need to be careful of the ISA allowance. So ISAs have an allowance that the maximum amount you can contribute to them each year is currently £20,000 per annum. So obviously if you take more lump sum out of your pension than 20,000, you won't be able to put it all into an ISA. You'd have to wait for the next tax year. I'd also question whether that's the right thing to do, because if the way pensions and investment and ISAs work from an investment point of view, money inside both wrappers, it grows tax-free. Money inside a pension grows tax-free, money inside an ISA grows tax-free. So there's no real difference in terms of the investment side there. And the key thing is, if you take out the 25% now, obviously you're locking in that 25%. By leaving money in the pension, hopefully it will grow longer over time and more, so that your 25% is of a larger pot. But if you take it out today, you've effectively crystallized that with no further ability to take out tax-free cash. So, just for putting it into an ISA for the sake of it, it's not really a good reason. And someone's also asked, is it better to invest in a pension or an ISA? And again, this will really depend on your sort of own individual circumstances. It will depend on your tax position, how much flexibility you want, and inheritance tax. If inheritance tax is a big thing for you, if you remember, your pensions are something you can save into, and the amount in your pension will never be subject to inheritance tax. Whereas an ISA is. Money inside an ISA is subject to inheritance tax. So there's one reason to consider. Okay, someone's asked about our fees, financial advice fees for managing pensions and giving advice. So all this information is on our website, which I'll give you the details of shortly. Yes, it's difficult to say exactly what the fee would be because it's sort of unique to your own situation. Like I say, the details of that process is on the website, so you'll be able to look and find everything you need on there. Okay, as I say, if you have got any more questions, do come back to me separately. I just wanted to say we do have the next webinar coming up on the 10th of February on Wednesday again at 11 o'clock. And this is going to go through the 2 techniques that will increase your pension value and boost your retirement income. So we're going to tell you exactly what you need to do to get a bigger pension pot for your retirement. So I hope you can all join us for that. And on the email I send out shortly, I'll also give a link to how you can register for that. So that's it for now. Really appreciate you joining me today. Thanks a lot for your time. Our details are on there. There's the mention of the website. The website has lots of blogs on there, guides, videos. You can book an appointment through the website, and we're currently offering a free pension review worth £497. So if you are thinking of retirement, you're not sure what your pensions will do for you, do get in touch and take advantage of that. But until next time, everyone stay safe, stay well, and hopefully we'll speak soon. Thank you.